Hey there and welcome. Today, we're going to crack open that black box we call an insurance premium. We're not just going to show you what's inside that number, but more importantly, how you can actually get in the driver's seat and start to control it.
You know the feeling, right? You get that insurance quote, you see the price, and your first thought is just, why? Why is it so high? It's super frustrating, for sure. But here's the thing. That number isn't just pulled out of thin air. And I promise, by the time we're done here, you're going to understand the exact logic behind it.
All right, so let's start at square one. Before we can really get into why your premium is what it is, we've got to be crystal clear on what a premium even is.
It's actually pretty simple. The premium? That's just the price tag for your insurance policy. It's the amount you pay, usually every year, to hand off your financial risk to an insurance company. You can almost think of it like your annual subscription to, well, peace of mind.
Okay, so how in the world do they land on that specific number? Well, it's not a guess. It's a really detailed calculation, kind of like a recipe, actually. They take a bunch of different ingredients or factors, mix them all together, and that's how they figure out your specific level of risk. So let's check out what those main ingredients are.
First up, and this is a big one, your industry. I mean, it just makes sense, right? A construction company is going to have way more on-site risks than, say, a graphic design agency. Insurers know this stuff inside and out, so if you're in a higher risk field, you're pretty much always going to see a higher premium.
All right, next ingredient in the recipe is your annual revenue. For an insurer, this is a super quick way to get a handle on the size of your business. Think about it. A company pulling in $10 million a year has a lot more on the line and a lot more to potentially lose in a claim than a smaller business making $50,000. So yeah, more revenue usually equals more exposure, which means a higher premium.
Then you've got your cover limits. This is just the max amount the insurance company will pay out if you have to make a claim. It's a straight-up trade. If you want a policy that covers you for up to $5 million, it's going to cost more than a policy that only covers you for $1 million. More protection means a higher price. Simple as that. Okay, this next one is all about your track record. You have to remember, insurers are basically in the business of predicting the future by looking at the past. So if you've made a bunch of claims before, they're going to look at you and think, they're probably more likely to make claims again. But if you have a squeaky clean record, no claims, that can actually get you some nice discounts and a lower price down the road. Let's talk about the excess. You might also know it as a deductible. This is the chunk of money you agree to pay yourself before your insurance coverage even starts. Now, why does this matter? Well, if you choose a higher excess, you're basically telling the insurer, hey, I'm willing to take on more of the risk myself. They love that because it lowers what they might have to pay out, and so in return, they'll lower your premium. And it doesn't stop with those big five. Oh no, insurers get really into the details. They're going to look at exactly what you do every day, where your business is, are you in an area that's prone to floods or theft, and even who you've got on your team, like their training and how much experience they have. Every little piece of information helps them build a really complete picture of your unique risk profile.
Okay, so once that premium number is calculated, you hit a fork in the road. You've got a choice to make, and it can have a real impact on your wallet. Let's break down how just the way you pay can change how much you spend in total.
So let's say your annual premium comes out to $1,200. You've got two options. Option one, pay it all up front. Done. Option two, pay monthly. Now, a monthly payment of, say, $110 might feel a lot easier to handle, but let's actually do the math here. $110 a month times 12 months, that's actually $1,320.
That's an extra $120 a year. For what? Just for the convenience of breaking up the payments. So, by paying annually, right at the start, you pocket that cash. It's a perfect, simple example of how a small choice can put real money back in your pocket.
And this is the really important part. You are not just a spectator here. You're not powerless. Now that you know how they cook up that premium, let's talk about what you can do to take control and actively bring that number down.
Here are 4 really powerful ways to do it. 1. Choose a higher excess. 2. Work hard to keep that claims history clean. We already talked about how big that is. 3. Put some solid risk management in place. We're talking safety rules, security systems, anything that proves to the insurer that you're a safe bet. And number 4, review your coverage every single year. You don't want to be paying for protection you don't even need anymore.
You know, let's just circle back to that higher excess idea for a second, because the savings can be huge. We're talking about potentially shaving 20 to 30% off your annual premium. just by agreeing to pay a bit more yourself if a claim happens. That's a massive discount.
All right, we're coming to our final point. And honestly, this might be the most important thing we talk about today. Because after all this focus on lowering your price, it is so easy to walk right into a really common trap.
I really want you to hear this one. The goal is not just to find the cheapest policy out there. I know a low price feels like a victory, but if that cheap policy is full of holes and gaps in coverage, it could be completely useless when you actually need it. And you could be the one stuck with a gigantic bill for something you assumed was covered.
So, let's wrap this all up. What's the bottom line? First, your premium isn't some random number. It's a careful calculation of your risk. Second, the choices you make, your excess, your safety measures, all of it, have a direct impact on what you pay. But most importantly, always remember the goal is value, not just the lowest price. Because at the end of the day, the right coverage is the only thing that's actually going to protect you.
And that really just leaves us with one final question for you to think about. When you look at your own insurance policy, what are you seeing? Is it cheap or is it truly valuable? It's a really important question to ask yourself. Thanks for tuning in.